Let us discuss Shariah Screening. Shariah Screening of the company, which the fund needs to invest, is done on the basis of prescribed Shariah parameters in relation to the nature of business and the financial dealings of the respective company. The Shariah principles regarding nature of business of the company for the investment purpose. The basic rule regarding the nature of business of the company is that the core business activity of the company, according to its Article of Associations, should not be prohibited by Shariah, one such as the production and distribution of alcohol, tobacco, pork-related products, conventional financial services, vulgar entertainment, etc. Now, on the financial dealings of a company, there is a ceiling provided by the Shariah scholars with respect to the considered financial parameters. If any company exceeds the ceiling, then it is considered to be prohibited for investment. What are those considered financial parameters? The financial parameters are the income generated through non-Shariah compliant activities of the company and interest-bearing debt, cash, and cash equivalents. All the parameters except income generated through non-Shariah compliant activities of the company are compared with the total assets of the company. The total assets of the company generally means the current assets of the company, like cash and cash equivalent, the long-term investments of the company, the value of the fixed assets of the company, like the building machinery, etc., and also the value of intangible assets, like the franchise rights, patents, and copyrights. Whereas the income generated through non-Shariah compliant activities of the company is referred in relation to total income of the company. For example, the income generated from gambling, pork, liquor, non-halal food, etc. should not exceed 5% of the company's total revenue. The same ratio, however, for some other activities like hotel and resort operations, stock brokerage, rental from non-Shariah compliant activities, etc., is set at 20%. Let us see if all the parameters have the same ceiling. The answer is yes, almost. For example, the interest-bearing debt, cash and cash equivalents have the ceiling of 33%. Whereas for the income generated through non-Shariah compliant activities of the company, the ceiling is either 5% or 20%, as explained earlier. Let us see the principle behind using only 33% ceiling. It is a guiding principle Shariah scholars have laid down as an exception after analyzing thoroughly the current financial situation of the companies. We were talking about the company's debt and equity structure. Let's start with debt. Debt is one of the important sources for almost every company to raise the fund or capital. The capital raised helps in formation of assets. So, when the fund manager purchases a share of any company for investment, the share reflects the ownership rights in the underlying assets of the company. But if the capital structure consists of equity, that is, the part of capital contributed by the owner of the company, as well as the debt, that is, the part of capital borrowed from others, then the underlying asset also reflects the same proportion of the equity and debt. If the debt in the capital structure is more than 33%, then it means the whole capital is debt, and in relation to that, the asset formed by the capital is considered as debt. And in Shariah perspective, one cannot trade the debt or debt-based instrument at premium or at discount, as it is riba, that is, interest, which is prohibited in Islam. Let us discuss about the ruling regarding debt. Let us take a similar example of Company B. The Company B has taken an interest-based loan of Ringgit Malaysia 25. The Company B has also taken an Islamic financing facility of Ringgit Malaysia 25. The value of the total assets of the Company B is Ringgit Malaysia 100. So, to see whether this Company B qualifies debt screening, what we do is divide the interest-based loan of Ringgit Malaysia 25 by the total assets of the company, which is Ringgit Malaysia 100. So the answer we get is 25%, which is less than the ceiling, which is 33%. Therefore, in Company B, Islamic funds can invest. Your observation is right. We have not added the Islamic debt in our calculation. As per Securities Commission regulation, not all the debt shall be accounted for. Only interest-bearing debt shall be included in calculating the debt over total asset ratio, and if it doesn't exceed 33%, the company shall be considered as Sharia compliant, and the investment shall be permissible in it. Now, cash and equivalents. The screening for cash, as well as the cash equivalents, is similar. Cash is, of course, the cash which the company has, and the cash equivalents are assets that are readily convertible into cash, such as securities, shares, and bonds. As per the Securities Commission's revised screening methodology, only that cash shall be included in the calculation which is deposited in a conventional bank. The cash placed in the Islamic bank will not be the part of the calculation. Let us understand this with an example. There is a Company A. Company A has borrowed Ringgit Malaysia 10 on interest-based loan. The Company A has a cash of Ringgit Malaysia 5 in a conventional bank account. The Company A has a cash of Ringgit Malaysia 5 in an Islamic bank account. The company has few cash equivalents, like shares and bonds of value Ringgit Malaysia 10. Now the interest-based loan plus the cash equivalents is equal to Ringgit Malaysia 25. Yes, you are right. We have not added the cash in the Islamic bank account. For the sake of understanding, let us consider that the total value of the Company A's assets is Ringgit Malaysia 100. So to know if this Company A qualifies for investment from Sharia perspective, we have to divide 25 by 100, and the value will be 25%, which means that this is less than 33%, which is the ceiling. Therefore, it is allowed for the Islamic fund to invest in the Company A. These two parameters are viewed from the tangibility perspective. In Sharia, it is necessary that any financial instrument which is traded in the market must be backed by a tangible or physical asset. If the fund manager is trading in a share of company, then cash and cash equivalents of the company must be less than 33%. If either of the two parameters exceeds the ceiling, then the asset will be considered as cash. Hence, trading in the instrument backed by such an asset is not allowed in Sharia, because one cannot trade the cash at premium or at discount, as it resembles riba, interest, which is prohibited in Islam. Now you may ask the logic behind 5% and 20% ceiling in income from non-Sharia compliant activities. It is simple that due to the unavailability of Islamic financial services, some companies may involve in interest-based earning. In addition to this, some companies may earn through some of their activities which are non-Sharia compliant. By the way, in case of impure income, the investor has to purify its return proportionately.